Good evening, this is Ken Long from Tortoise Capital with a review of the weekend trading report for January 31st, 2016. We have a market that is in bear volatile condition. On an annual basis using weekly RSI 14, we're at 44 out of 100. 10-day basis using 10-day NDX, we're deeply overbought at 99 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is minus 4.44%. Still red bearish, but a nice move this past week. Slope of the 50 has improved to minus 0.65, but remains red bearish. The risk index is the 30-period moving average of the VIX divided by the 10-period. The current reading is 0.915. The boundary between risk on and risk off is 1.0, so we are still deeply into risk off. We take that score of 0.915, compare it to the last 5,000 trading days, find the average and the standard deviation. That allows us to compute the risk Z, which right now is minus 1.06. This is a 90-day histogram of that reading. You can see that we were as deep as minus 2 sigma. We've improved to minus 1 sigma. This is the sweet spot for starting swing trades in bull markets, but because we're in a bear, I'm still very careful and cautious about the overnight risk, and I'm ready to play one-day large moves going long as on Friday because of this improving volatility condition, but I'm mindful that we're still in a bear market. This is a blended monthly rebalancing holdings for January. These are the holdings projected going forward with the next reevaluation due this week. These are the scores as of close of business Friday. If you wait till close of business Monday, we might see a slight difference in performance here, but these are the current readings as of Friday. ETF2, the theoretical model, is still at 0% exposed. The model portfolio itself will be at 70% exposed with stops in place. Here's a quick look at the blended monthly rebalancing portfolio holdings and their performance. You see just how bad things are with the exception of treasuries. Just note the conservative plays like U.S. real estate and large caps are at the top. And then we look at ETF 32, that includes consumer staples and utilities among the top three. China, Brazil, Latin America still remain the worst overall, joined by blended commodities. ETF maximum, just noticed how volatile the leading contenders are, and that leads me to review that statement about the importance of being patient in this bearish market with swing trading, because even the relative strength leaders can get the big smackdown, as you can see here. Some of the gains, the big gainers from this last week: power shares, dynamic utilities, again utilities, more utilities, looking pretty much like utilities, up about 5% across the board. And consumer staples, equal weight, looks interesting at 32. But otherwise, you can see this was a rejection of the previous defensive plays from the previous 2, 3, 4 weeks. So volatile times caused me to tighten up my time frame. This is the S&P 500. You're seeing the same thing here that we saw in the ETFs, and that is that the relative strength winners from last week all were underperforming this week, although still a 4% gain in Tyson Foods is below average, but still that's an average you might be happy to take. Green Mountain for solar remains always interesting. Coach will be attracting some money for momentum plays with a 22% gain, as would Facebook, up 15%. Looking at the market health check, we have that nice move on Friday. Still brings us up to not quite the Bollinger Band mean in the middle of the river. We've crossed the dragon. The slope of the 10-period regression line is up. Slope of the regression line is up. The 30 is still deeply down and just started to improve a little bit. You can see that we're already that the slope is at minus 0.75, and that's extraordinarily steeply down compared to the long-term benchmark of minus 0.22. Anytime it gets past minus 0.22, that's troublesome. You can see that occurred right in this period here. The second leg down, if you will. But this is looking like a bottoming tail, and the percent price oscillator alerted us to the changing conditions back here. Jaws are still open to the upside. I'm looking at targets of the Bollinger Band mean, far side of the river, and then retesting the high at 212. It's all tactical trading inside this until we get above the previous swing high of 212, which, to be fair, has been tested 3 times and failed. So 197 is the next leg up. ETF2 regional report, everything on cash. We're still in the model at 0% invested, 100% cash. Bear volatile. The S&P at 63 is better than the globals, EFA at 58. Inside the U.S., it's really large caps, tech, mid caps, small caps. Large caps and tech are the 2 strongest. Latin America and emerging markets, the 2 weakest. Strength in consumer staples and utilities inside the sector spiders. World market model. Only the U.S. large caps are above average in the U.S. Every mids and smalls of each type are below average. Japan, China, Australia above average, in Asia, Malaysia, and Indonesia especially so. Vietnam and those in yellow lagging. Latin America, emerging markets are weak. Brazil weaker. Everything Europe is weak, with the exception of Belgium and Netherlands. The staples and utilities strength is a global business sector kind of a phenomenon. Commodities and oil still suffering. Gold and silver above average. Treasuries, the risk-free rate of return. Bonds and U.S. real estate doing well. ETF top 30. Those that are greens all the way across the board are the long-term gainers, so the bullish dollar. Consumer staples, power shares, preferreds, and then these that are green and white are relatively new in the business cycle of improving, and these tend still to be the income producing funds. Among the Dow 30, McDonald's still leading the way, Microsoft doing well, Walmart has rebounded nicely, strength in the usual suspects in the consumer staples defensive plays. Procter & Gamble, General Electric, Johnson & Johnson, Home Depot, Coke. The red is starting to affect the bottom half of the stack here. American Express, reds across the board. And then red and yellow, or red and white, means a recent smackdown in Cisco, Disney, Boeing, and Apple. Looking at the average daily dollar volume of the last 30 days for the most liquid ETFs, and then their relative volatility. Those in the green are the ones that are both exceptionally volatile and very liquid for intraday trading. Shifting to the daily report, going to see just about everything triggering short signals on the overreaction system, and that's not surprising given that that the markets tend to converge during these bearish sell-offs, and so when something fires an overreaction, everything fires on the overreaction. You can see that volatility has started to roll over from almost plus 2 sigma, coming back towards the average. The bullish momentum starting to improve, although bears are still in charge. a handful of overreaction signals here among the tactical on the tactical screen for the Dow 30. American Express continues to be an interesting play. You see how much it's been beaten down over these various look-back time periods. A handful of quality frog numbers here. Lots of overreaction short signals here on the ETFs. Now, I take that to be a market condition as opposed to individual sector signals. So I'm really going to be looking for getting the market call right and playing this as a one day at a time. I won't automatically take the short at the open, but I will wait to see evidence of weakness by making new intraday lows, and then if it takes out Friday's low, that would be a large vote against that last run up on Friday. From the auto framer for decent candidates here, including American Express. And then the regression line fractal framework. This will give you the insights into on the top shelf here in the green. These are the most ATRs below their own RL270, so we treat the RL270 as the fair value longer term. And so these, like American Express, is 7.5 ATR units below its own RL270. So that's a $2 ATR, so it's $15 below its long-term fair value by this. And these in the red on the bottom are relative strength leaders, so that's the usual suspects right now. A Walmart, which is 6.5 ATRs beyond its long-term fair value. Procter & Gamble, Verizon, Microsoft, or McDonald's, and AT&T. Verizon, Procter & Gamble, these are all symbols that really look attractive, which we'll see later on the weekend webinar, and we'll do some framing of those in the swing trade online workshop, which starts off tonight. Daily squeezes, a handful of goodies to look at here. I like that XIV and AXP are both in there. You can see the regression line slope improvement has started here. You can see the polynomial slope has changed as the 30 begins to lessen its descent, and you can see that we've now seen that slope line cross its own 10-period moving average at a distance more than one standard deviation from the long-term average. This has always been an interesting moment when the market could turn. And the last time it did, it had a 15% move off its local minimum and had a terrific move all the way up into the end of the year, and which it now has given all the way back. So this move here corresponded with a turning point here. We just made that warning sign, that warning light for be prepared for a shift in orientation to the long side. You can see that the slope of the 30 is now the second worst in the last 10 years. Volatility rolling over by both of these measures. And I would just highlight, from extreme conditions come extreme results, and that's why I focus on trying to understand the turning points carefully and don't get locked into just everything must be down. I know that if there's failure, it's an easy trade to the south, but there are also signs that the long side trade are starting to work, some green shoots, if you will. Now, it looks exactly the same under both systems. That the overreaction short signal fires just exactly when you see some evidence of resumption of the bull or a return towards the bull. And so the fact that there's strong evidence on both sides makes this a very interesting time to start to be trading it, and I like to shorten up my time horizon and then let the market's actual direction guide me towards the side I want to take. So I have no directional bias whatsoever right now. I just am expecting more volatility and lots of intraday momentum and big moves intraday, like we saw on Friday. Think of it as swing trading one day at a time. Just flash through the stats real quick. You can stop the tape if you need to. On the z-scores of the regression line slopes, we're looking at the 90, the 30, and the 10. You can see that the 10-period z-score has moved from -4 to +2, a 6 sigma improvement in steepness. The 30 has started to hook up, as we've seen on other charts. The 90 has completed its move from +1 down to -1. And so if we actually do get support here, where we've seen support the last 2 times it was here, then a move back up to about 205 would not be surprising. And then that would allow the 30 to continue to improve. And that would be a nice 8-point move, almost a 5% rebound from current price level. So this is certainly, the long side is in play. And then it's about 6.5% down to test this low again. And if it fails here, then I think you see another one of these large spike downs, spike moves like this one, and like this one. So perfectly placed at a critical state, but you can see that the dragon has come back to the river for a drink, and now is he going to continue to the far side? If so, that's not an abnormal move. That would take it to 205. Flipping through the slides for you. If you need to stop it and review, you can. Now this measures the convergence of the different correlation coefficients with respect to the market. This is market neutral, so this the flat line is perfectly correlated. Now I want you to notice that this tightening, this almost 1.5 sigma worth of tightening, this is what happens after selling periods. And then were we to see a nice upward move, then you would see the correlation coefficients with respect to the market start to deviate as money starts chasing the leading sectors or countries, and then you start to see a divergence in performance. This was that nice run up to the last time we got to 212. This is part of this sell-off, how tightly things have converged. And so they're, more than half of them are exceptionally strongly correlated to the S&P. That's when they're correlated at 1.5 sigma. That's an exceptionally strong correlation to the market. And this just shows evidence that the markets really do converge during global sell-offs like that. Like during the nice run-up, Latin America was lagging so much that it was the one that was least correlated to the market, because it was just stuttering and failing while the market was going up. And because the market has been failing and Latin America continues to fail, that's why that correlation is tightened up all the way to the 1.6 sigma side. Only Japan right now is the least correlated, and something like normal. Their market is so big and it's such a hard thing to trade that it just kind of chunks along at its own rate. All right, so that's everything I wanted to cover from the weekend report. Thanks for your kind attention. And again, we're starting the swing trade workshop later tonight, and that looks like an interesting 10 to 12 week project going forward. So take good care. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.